Chapter 12 deals with diversification, and that topic was also discussed in Chapter 8 on asset allocation because the goal of asset allocation is to accomplish a certain degree of diversification, hopefully, a great deal of diversification. But I also want to point out that investing is not necessarily about trying to achieve a certain return. It's realizing that risk exists and trying to manage that risk and at the same time accomplish the best possible return you can for a given risk level. And that's what I try to do. And part of what I showed you in chapter 8 with asset allocation, my goal was to optimally weight my different asset classes to accomplish a certain level of risk and maximize my return at that risk level. Now, that's what I tried to show you in chapter 8. Chapter 12 really just relates to diversification and how, like, combining certain types of assets won't necessarily diversify your portfolio, which I think a lot of people mistakenly think it will. Like they might think, well, I've got the Vanguard 500 index fund here and the Vanguard Total Stock Market Index fund here. I'm just going to buy, let's say, an equal amount in both of those, and that should diversify me. But it's not going to do that, and I'm going to explain why. But before I do that, I want to talk to you about some examples of non-diversification. I know personally a couple of people who insist on putting 100% of their money in gold. And, regardless of how I explain to them how that's not diversified, how gold's returns are actually, gold is not a dominant asset. If you think back to chapter 8 when I showed you that graph and I explained which indexes were dominant versus non-dominant, I didn't have gold on there, but had I plotted gold on there, it would not have been a dominant asset because I have actually looked at that. And so in that sense, it's not a particularly good investment. There are also lots of examples back in the early 90s, I believe it was, when Enron actually existed as a corporation. There were lots of people who put 100% of their money in Enron. And then Enron went bankrupt and they lost every penny that they had invested. I also, a couple of years ago, when I first started teaching this course, I had a student in the course and he just inherited a fair amount of money, over $500,000, and he had put, I think, virtually every penny in Microsoft stock. Now, Microsoft stock, if you look at it from the very beginning when it first became a publicly traded company to today, you will have earned a decent return. But if you look at it just over the last couple of years, it's not done particularly well. And he didn't buy into Microsoft stock when it first became publicly traded. He bought into it a couple of years ago. So he was not diversified and he actually didn't do very well. Had he been diversified and put his money in the overall stock market, he would have done much better. But that actually calls attention to this topic. When you focus your investments, so you put all your money in a particular company, so here I'm going to say focusing. I don't know exactly how to phrase that. Focusing your investments means that one of two things can happen. You can experience the extreme highs of the stock market, of investing in a single, I'll say, company's stock. And that can work out really well for you. Or you can experience the extreme lows of investing in a single company's stock. So, gosh, one time I bought a company for 50 cents a share, and a year later I sold it for $11 a share. That's a huge, huge, huge gain. If I had put all of my money in that particular company, I would have been a very rich person. I didn't, because I like to diversify, because I like what diversification accomplishes for me. When I bought that stock for 50 cents, it was a risk, and I knew it was a risk. There was a very good chance that company could have gone bankrupt. It was having a lot of trouble, but I took the risk that it was going to recover, and it did. This was back in 2008, I believe, when a lot of companies were having financial difficulty. Quite a few companies actually did declare bankruptcy. If that company had been one of those, I would have lost all the money that I put into it, which is the worst possible scenario. During the same time period, Crocs, the company that makes those gardening shoes, actually lost about 97% of its value. So had I put all my money in Crocs, I would have lost almost everything. So those are examples of extreme highs and lows from focusing your investments. Diversification, on the other hand, smooths out that variability, which is a good thing. So diversification, well, it's a good thing because I don't really enjoy taking risk. Yes, I invested in that particular company and I knew it was a risky venture, but I only put a little bit of money in that company. So it was not by any stretch of the imagination anywhere close to the bulk of my portfolio. I just kind of get some pleasure from managing some of my money myself and not investing it in an index fund, but it's only about 5% of my money that I invest that way. So diversification smooths out the variability in returns. So by investing in diversified portfolios, you're not going to have the huge swings. You will have swings, definitely, but they won't be nearly as large as if you'd invested in an extremely risky stock. And so by smoothing out those returns, it reduces risk. And generally speaking, that's what I like. Not that I want zero risk, because with zero risk comes very, very low returns, and I want decently high returns. So how do you diversify? And we've already talked about this. You find securities that have low or hopefully negative correlations. And remember, we talked about the correlation coefficient in chapter 8. And it can range from 0 to 1. Sorry. It can range from -1 to 1. Most stocks have a correlation that's positive. Most equity index funds would have a correlation that's positive. And I can't remember if I mentioned this in chapter 8 or not, but over the last 30 years or so, what has happened is that the stock markets in all over the world have become more closely correlated. That's actually, in terms of diversification, hurt us, because the more positively, and I should probably put that here, positively correlated. I in my mind, that's what it means, but just to spell it out. So in terms of diversification, more positive correlation or higher positive correlation is not a good thing. So that means to become diversified, we actually need to add more asset classes to our portfolio than we used to, or change the weighting scheme compared to the way it used to be weighted. Or if we're investing in individual stocks, which I'm not recommending, we'd need to add more stocks to our portfolio. And we can also smooth out our returns even more by adding bonds. And again, smoothing out returns, the variability in returns reduces that risk. The problem with adding bonds is that also reduces our return. Adding bonds is not a bad thing. It just depends on where you are in your life. Are you close to retirement and you don't have that many years to recover from a huge drop in the overall stock market? If so, then maybe you should have a, well, you not maybe, but you should have a higher weight in bonds than someone who's 20 or maybe even 30, who has quite a few years before they need to use the money they're saving for retirement, and they can afford to suffer a huge loss because they have time to recover from that. So, if you own a large number of mutual funds, that doesn't necessarily mean you're diversified. And even if they're index mutual funds, it doesn't necessarily mean you're diversified. They need to be from a variety of different asset classes. Now, I only have a fairly quick example, but here's hoping I can find it. What I have on the screen is the returns on the Vanguard Emerging Stock Market Index. Sorry, I had to pause for a minute and I can't remember what I was saying. And actually, this is not the one I want on the screen, so I'm going to... oh, I can't make it disappear. I was going to make it oh, actually, I can. No, I can't. Now all this is messed up. Okay, let's see. I'm going to make this one go away. I can't. Sorry. All right. No, it did go away. I'm using a new computer and it's very slow. I'm actually using a tablet. But anyway, what is on screen right now are the returns for the Vanguard 500 for the past 20 years. And this is actually interesting because you can see that there have been huge peaks and some low valleys, another huge peak, another low valley, another huge peak, which suggests perhaps another low valley is coming along. But past performance does not guarantee future performance. At any rate, I'll talk more about this in the chapter on market timing. But here's the Vanguard 500, and so this particular index fund invests in all 500 stocks of the Standard & Poor's 500. And let's say we decide to add this index fund to it. This is the Vanguard Total Stock Market Index Fund. It has about 4,000 stocks in it. They're generally U.S. based. I like the bulk of them, over 90%, if not more than that, are U.S. based. Well, again, the majority of stocks in the Vanguard 500 are U.S. based too. So I'm just going to turn this on by clicking the I. So now both of these indexes are plotted. These are the returns for the last 20 years. So, and you can see they move very closely together. So if these were the only two funds that you owned, it's overkill because you're not getting much diversification benefits since they tend to move very closely together and have for a long time. You can't move much more closely together than these two indexes. So basically there's a bunch of overlap. By adding, let's say if you bought the Vanguard 500 first, by adding the Vanguard Total Stock Market Fund, you didn't boost your diversification really any noticeable amount at all. So it was just a poor second choice to add. But let's say you decided to add the VEIEX, which is the Vanguard Emerging Markets Index Fund. Emerging markets, so this particular fund doesn't have any U.S.-based stocks in it. It only owns stocks in countries that have recently started publicly trading companies and experiencing the effects of capitalism. So I'm just going to turn this index on so you can see it. And you can see that there have been times in the past, specifically right here, this was during the financial crisis, when the two indexes moved fairly closely together, but the rest of the time they've not moved particularly closely together. What that is doing is diversifying your portfolio. And I could add some other indexes in here Like, I didn't actually list any more to add, but these two right here are large cap. Actually, no, that's not true. The Vanco Total Stock Market Index has small caps and large caps in it, but probably about 75% of that particular fund is large cap, where most of this fund is large cap. It's just that if you look at the cap of large cap companies and then the cap of small cap companies, the large cap companies just overpower the small cap companies. So if I added a small cap index, and let me see if I can't think of one right off the top of my head, and I'm hoping by typing this in, oh, this one I do recognize. So here's a small cap US based, I believe, uh, index, but it looks like my computer's taking a while to actually add it. Oh, it did add it. There it is. So you can see this, I don't know what color that is, fuchsia maybe, or magenta. This fuchsia line, again, does not move perfectly in tandem with the two large cap indexes. It does kind of, I mean, I would say it has positive correlation because when one rises, the other rises, but they don't change by exactly the same degree, especially not during this particular time period. It does look like more recently they do tend to move more closely together than they used to. And that actually just builds on the idea of what I said earlier, that in recent times, world indexes have tended to move more closely together than they used to. But basically, the idea behind chapter 12 is when you choose indexes, make sure you don't choose indexes that have a lot of overlap, because otherwise, adding that next index to your portfolio, next index fund to your portfolio, isn't going to diversify you because you're just pulling in this same type of asset that your other index funds have. So you need to look at them, get an idea of how they correlate with each other, and make your decisions on which index funds to add based on that. Unfortunately, there is no website that I am aware of that you can look at different funds and see how they correlate with each other. It's something you have to just eyeball, like I'm doing here with this graph, or actually understand the math behind the correlation coefficient and calculate it yourself, which I think is beyond the scope of this class. So I would just kind of eyeball them and get a feel for how they move with each other and make your decisions on how you're going to allocate your assets based on choosing asset classes, broad asset classes represented by index funds that have non perfect correlation with each other. That's going to diversify you.